Hey guys, it's Vlad. In this video I'm gonna talk about the interest rates. What is firstly interest rate, how interest rates are created, and the most important part is gonna be when should we expect the interest rates to go down, especially for real estate third-year mortgage rates. Interest rate is the cost of money, or in other words, it's the money you pay when you borrow money or the money you get when you lend money expressed as a fraction or percentage of the money you borrow or lend. Since interest rate is the cost or price of money, it is created similarly as the price of any good and service in any free market by the demand and supply, and where they meet is the equilibrium or the price at which people with excess money are willing to loan to people who need the money. The demand for money is mainly affected by the interest rates, the anticipation of inflation, and the overall economic climate. When the economy is forecasted to do good, people feel that good times are ahead of them and are willing to borrow more. The supply of money in the US is influenced heavily by the Fed and the three main tools the Fed is implementing. Number one is the quantitative easing and tightening through open market operations, and this is the most important one. Number two is the discount rate or overnight lending between banks. Bigger banks usually are borrowing at lower rate from the Fed and lending the money at higher rate to smaller banks, keeping the spread. And number three is the reserve requirement, or the percentage that banks have to keep in cash from deposits. Lower the reserve requirement from the Fed, that means that more money can be lent from the deposits to the public and more profits to be made. The most important of these three tools is the first one, or the open market operations, where the Fed is directly increasing or decreasing the money supply by buying and selling securities. When the Fed is trying to increase the money supply, they're buying securities and sending money into the economy. And when they try to decrease the money supply, they're selling securities, collecting money, and therefore lowering the money circulating the economy. When it comes to predicting the future or where the interest rates will go, we can't give a definitive answer, since even the almighty Fed can't, but we can give a close estimation on when we should see interest rates to start going down. Interest rates have a negative correlation with the money supply, and when money supply goes up, the interest rates goes down. This is similar to the picture here with the exercise and the weight. More you exercise, less you're gonna wait. This is the same logic from the supply-demand curve. When the supply goes up but demand stays same, the price goes down. Based on the recent quantitative tightening from the Fed, we hit the peak of M2 money supply in July of 2022 at $21.7 trillion, and since then the money supply is going down roughly by $100 billion per month, currently standing at 21.1 trillion. Since 1980, the US had inflation rates in the range of 1.4%, which is acceptable range. During this period, the money supply increased by 6.5%, which promoted GDP growth and didn't spike the inflation levels. And this meant that the Fed had figured out how much money they can print without creating inflation. All of that changed when we were hit with a global pandemic, COVID-19, and the Fed, in a panic, printed over $3 trillion in a period of 9 months. If we take the same growth that we had pre-COVID of 6.5% year-over-year money supply increase and apply it to 2019, at the end of 2019 when we are at $15.3 trillion, we should be at 19.7 trillion at the end of 2023. Currently we are at 21.1 trillion, which means we need to cut additional $1.3 trillion to get to the same level of money supply if we follow the 6.5% year-over-year growth of money supply increase. Based on current monthly Fed money contractions, it will take around 8 more months, if they continue to do what they do, to get to the same level with the 6.5% year-over-year growth if the COVID crazy quantitative easing didn't happen. So my best educated guess about when we will see the Fed start increasing the money supply again and interest rates start going down to pre-COVID levels of 4 to 5% for 30-year mortgage. This will be by the end of 2023. We have to remember that the Fed cannot continue with the quantitative tightening for a very long time, since if they do, they're gonna create another situation when we're gonna enter deflationary grounds, which is much worse than the current one of inflation. So that's my answer there, what I think when we're gonna see interest rates going down. I think it's gonna happen somewhere by the end of 2023 if all the things stay the same and the Fed continue with their money supply cuts every month of roughly $100 billion. So let me know what you think in the comments below if you agree or disagree with me.